Hello, I'm Michael Graham, president of Midwestern Securities and host of Banking on Growth. Thank you for being with us today. With us as our guest is our friend Loyd Pohl from Pohl Consulting. Welcome, Loyd.
Good afternoon.
Thank you for being with us. You and I have known each other kind of off and on. We've gotten to know each other a lot more in the last 6 or 8 months. But for our audience, will you share who you are, a little bit about your professional background and your company's background as well, please?
Sure. The firm has been around since the late 70s, working in the trust and banking industry. Over the decades, we've diversified from sales training into benchmarking, into compliance consulting, into organizational development. Our roots are still in sales training, and we still do a lot of that, but we do almost anything a wealth management shop or trust shop would need. As far as I'm concerned, I was a banker for a couple of decades then. I was a prospect for this firm. Like a lot of folks in those days and these days, I lost my job 3 times in a row from mergers and acquisitions, and I decided to do something different. And I joined this firm in 1992, which is a long time ago, and ended up purchasing that firm in 2000. So that's me.
You're very humble. That's a very succinct background. That your reputation is much more robust than your humble self-acknowledgement. But we've bumped into each other with the Community Bankers Association of Illinois. And then, as an introducing broker-dealer, Midwestern Securities, from time to time has to go out for RFP for our clearing services and different vendor relationships. And last year, we were going through our RFP, looking at our clearing relationship. And one of the competing clearing firms, we're looking at, not only what can they do for us as a broker-dealer, but we're also an SEC-registered RIA. So we wanted to know what they could do for us there. And we have an interest in being involved in the corporate trustee space. And so we wanted them to be able to address all 3 platforms. In those discussions, they said, have you talked to Loyd Pohl about this? This is one of the biggest banks in the world, headquartered in New York. And they said, hey, have you talked to Loyd Pohl about this? I said, well, no, but I know who Loyd is. I've met with him before. So let's circle back. So your reputation precedes you. So Loyd, let's talk about trust services specifically, right? I mentioned we're in the BD space, the RIA. We have an interest in learning more and being more involved in trust services. Why do community financial institutions, community banks and credit unions, why do they offer trust services to their customers?
That's a fascinating question, and the answer has evolved over the decades and still depends on the organization. In too many cases, the answer is it's an accommodation to our clients. It's a service that we can add and make our clients stickier and all sorts of very appropriate reasons, period. But the real answer should be, in our humble opinion, to generate profitability, to contribute to the profitability of the company, of the bank. And a lot of organizations, especially the smaller departments, are not significant contributors, and some could be and should be. Yeah. So I think that's the real answer is an accommodation in many cases. The answer should be to contribute, to add to the profitability of the company.
It's interesting. So a lot of community banks have gotten by and able to afford these accommodations that they lose money on or have too much risk with for years. But it seems like that thought process is running out of tracks, that they can't do that anymore. They have to be more competitive and they have to be sharp in everything that they offer. What are some of the challenges or risks, however you'd want to look at it, that community banks face offering trust services?
It does vary by size, but there are some very common themes. The first one is the growing regulatory scrutiny and, dare I say, silly examinations. Things are coming out of left field that don't make a lot of sense. The regulators have had tremendous turnover. They've got people without trust experience doing exams, and out of that is coming silly examinations. I would use other words, but to be polite, they're silly things that come out of those exams. So that's one, the growing regulatory scrutiny that may or may not be as on target as it should be. The second is, and everybody's going to nod, is finding experienced trust personnel, whether it be a good person to help with backroom operations or a experienced fiduciary trust officer or a manager of a department. It is really hard to find experienced trust people, and many organizations have to compromise. They don't find that fully rounded trust officer. They find somebody with certain pieces of that experience set that they need, and then they have to figure out how to patch it together from there. So the difficulty in finding and, let's say, keeping experienced personnel, those are the two biggest challenges. And you mentioned risk, and I know that the banking industry is always very focused on that question of risk from a risk standpoint, from a fiduciary risk standpoint, from a legal risk standpoint. If you have experienced trust personnel, the true risk that a trust department creates for the bank is very, very, very minor. Yes, you can get sued. Yes, there is some litigation risk, but so minor. It's hard to put a mathematical expression to it like the bankers are used to with loan risk. So effectively, and people will argue this point, effectively zero risk to the capital of the bank.
I think it's important to reference one of the phrases you used in your answer, though. It was something to the effect of, if you have high quality, well-trained people.
Yep.
But if you've got an environment like we have now where it's hard to find good people, and you've got regulators that are not commonsensical, perhaps because of a lack of experience or a lack of training at the regulatory level, and then you've got a lack of talent pool and likely a lack of training at the smaller community bank levels, the risk, the regulatory risk and the financial risk would seem to increase exponentially.
Absolutely. And I'm glad you caught that caveat. If you have people who know what they're doing. And the compliance work we have been doing in our firm, not always, but a fair amount of it is due to that lack, right? Mm-hmm. You bring in a manager who may be great at investment management, but they've never done a discretionary distribution request. They look at account acceptance differently. And sometimes balls get dropped and regulatory scrutiny. I will maintain the third point. Again, even if you drop the ball or screw up, technical term, the true risk to the capital is still moderate. It's a little higher, but it's still moderate.
Okay, thank you. So they can offer it, but in order to offer it profitably and be able to grow it to keep up with the rising cost of wages, et cetera, what advice would you give community financial institutions in that regard?
in the regard of profitability.
Right. And an ongoing maintenance of profitability.
So I'm going to respond with an answer that I acknowledge is not popular or easily accepted. And I'm going to speak to small departments, not always in small banks, but small departments. If you're not generating over $1 million of revenue on an annual basis, you shouldn't be concerned about profitability. You should be concerned about growth. And you should be willing to invest in the things that will help that department grow to get to that level. It's around $1 million. If you can't get to $1 million worth of annual revenue, it's going to be hard to have any true definition of profitability. We can elaborate on that. There's different levels of profitability. There's covering your direct costs. It's covering the allocated costs. And then it's what we call sustainable profitability. That's the next level. And sustainable profitability is something like this. If I add an employee or I buy a piece of expensive technology, I don't go backwards, right? We define that, or that's our definition of sustainable profitability. And if you're less than $1 million of revenue, it's hard to argue that you're at a sustainable profitability level. So let me repeat it again so people can, did he really say that? If you're not generating $1 million, give or take, of revenue, you shouldn't be focused on profitability. You should be focused on growth. And once you get to that sustainable profitability, you can, all things being equal, nothing big happening in your organization, you can start increasing your profitability over the years beyond if you continue to grow. And a trust department that's past that critical mass, again, we can argue where that point is. But if they're past that critical mass and they're at a sustainable profitability level, profitability just keeps increasing, both in dollars and ultimately in percentages. And the pathway is clear. So my message was mostly focused on the smaller departments.
Let's stay here for a minute, Loyd. So let's say you're in a bank and the board says, we've got to make 15% on all of our business lines, and therefore we can't hire that third or fourth or fifth employee. And they put this, it's really an artificial constraint around the division head. How do you take this message, what you just said, which I think is really an important message? How do you take this to the boardroom or to the CEO and say, hey, you've got this wrong. It's too early to expect this 15%. And then when they say, well, how long should I give you? How do you answer, knowing board dynamics are all over the place?
I think I told you that my message was not popular or always well received, right? But the answer is, all right, let's talk about your market. Let's talk about the potential. Let's talk about the trajectory of your department. And if you can't grow, if you really don't believe you can grow to that level, then you need to make a different decision about your trust department. And you mentioned it earlier when I gave my diatribe about profitability. We can't afford a department not making money in these days. And if you can't grow it to the point where it's contributing in a reasonable period of time, right, then you have to make tough decisions. Now, you should make tough decisions. You don't have to do anything. A lot of banks close their eyes, hold their nose, and they just suffer, and they pretend that it's breaking even, maybe making a few bucks if they have a big estate, but they're really not making any profitability. And so it's grow or die. That's the message. Now, again, whether you accept that or not, that's what we see out there as time is passing.
Grow or die.
That's dramatic. How about this? Either grow or sell it.
There you go. There you go. It reminds me of one of our prior podcasts when Cassie, our EVP, was interviewing me, asked a similar question about just community banking. And my closing comment was in or out. If you're in, be in to win, and put the resources behind it. And if you're not in to win, then get out, find a suitable partner that does have the resources and still can provide the service to your community and the employment to your employees, and give them the opportunity to lead if they have a longer term vision or a more confident vision or more scale that they can spread their risk, or more talent in HR or redundancy in the trust departments or loan officers, et cetera. That was my reply, was in or out. Be decisive with it.
And I'll use yours. Either put some resources into it or out.
Is there anything else that you would share with an institution that has an unprofitable division along the way? Is there anything else you would tell them that these are steps that you could do before you got to that point of in or out? Maybe another way to look at that is, what are those resources that they could potentially put into it to try to fix it?
And this is the hard one. And this is why this is a hard conversation. Do you have the personnel that is going to grow it for you? Do you have the staff, and can you acquire the staff, or can you acquire the staff that will grow that department, who will be out there selling, who will stimulate referrals from the professionals in the community and the bankers? That's a tough question. And it's not always no, right? There are folks out there in these departments that, given the capacity, given the resources, given the support from the bank, could do that, can do that, have done that. But if the answer is no, and we can't find anybody, and we're not going to pay the price to hire somebody that way, see the prior answer.
Gotcha. Very good. And I think that's the value of a consultant, right? A little bit of distance, a little bit less emotional attachment, or it becomes clearer, and the right decisions become clearer as well. Along those lines, Loyd, what are some reasons why do banks continue to lose money and not be decisive?
A myriad of reasons. I will suggest inertia is a powerful force. Maybe we're on paper, I guess is the way to put it. We're not losing money. The monthly reports don't show anything red. We're not charging the department for anything, right? But on direct costs, they're covering it, and we have bigger fish to fry. Inertia and prioritization. Many banks are really struggling these days with other issues that are frankly more critical to the organization. And if the trust department is just muddling along, not creating problems, it's easy to say, yeah, but we're just not going to deal with it. And my answer to that is, okay, but you're probably, now I'm generalizing, and that may not be fair, but a lot of these smaller departments are one bad exam or one retirement or defection of an employee away from being in big trouble. So the inertia, I think, is an important one. Prioritization, prioritizing their challenges is another one. And my caution is, you're one bad incident from having to deal with it, and then you're dealing with the problem from a position of weakness.
Mm-hmm. Yeah. So the symptoms may not be terribly painful, but that doesn't mean it's not about to break or cause a bigger problem.
That's exactly right.
So don't put it off. Be attentive. Be proactive. Those are all good thoughts, and they're hard to do for community bankers that are they're dealing with the safety and soundness exam 1 minute, and they're dealing with the loan customer the next, and for them to find the mental white space to draw out, and then the energy to go and identify, understand, and fix. It's hard for them to do sometimes. I understand how they get trapped in this inertia. And that's when one of the things we talked to them about the wealth management division is you can't do everything. You need a team, and we want to be part of your team, even though we're not on your payroll or part of your board.
Yeah.
And they need a team like you, Pohl Consulting, that can give them this leadership that they may not have the expertise, the depth, the distance to.
We hope so.
To come to the right decisions. Yeah. So let's continue this pivot just a little bit now. For our audience, will you differentiate wealth management and trust services?
I will, but first, some amusement about the definition. There's trust departments that are labeled as wealth management. There's retail brokerage that is labeled as wealth management. There are RIAs, both owned by banks and not, that call themselves wealth management. So I want to say that for purposes of my answer, let's talk about trust versus retail brokerage. How many hours do we have left on this recording? It could take hours to address the relationships and how that can work with an organization that has both. I will throw in right now, because I just thought of it, I've run into organizations with brokerage and trust, and then somebody has the bright idea to buy an RIA. And they have 3 different platforms competing for the same client. And they haven't figured out how to handle brokerage and trust, and then they make it more complicated with RIAs. But let's answer your question. I don't hesitate really to say this, but I would ask the bank, do you need both? Right? Can you meet the needs of your clients with a retail program? Can you meet the needs of your clients with a trust platform? And so the question is, do you need both? And then which of those meets your needs bestest? Okay? If you have both and want to keep both, and you want them to play well together, if you want them to work together, if you want them to focus on the right things, I know this is hard and not always possible, but they need to report to the same person. And I don't mean the same bank executive. They need to report to the same head of wealth, head of financial services, whatever that label is. The other thing is within the restrictions of the different regulatory schemes, they need to cooperate, coordinate, work together, refer back and forth. We need to work on narrowing the difference between how they're compensated, which is an important and difficult issue. We need to address the service model. A $750,000 IRA client ought to have the same client experience no matter who they talk to in the building, right? And how do we accomplish that? It's not easy. We've talked about how organizations go through different phases over the years. We've talked about how organizations, they call it integration, but we argue that it's really hard to integrate. It's more about cooperating and communication with the 2 different regulatory screens. Ultimate integration is extremely difficult. Dual employees create certain challenges on the broker-dealer side, but it can be done. It can be done, but it's a challenge. I'm not sure I answered your question other than give you 3 or 4 things that we see that need to be discussed when you're talking about how you have these two different programs.
Yeah, is very good background. Good things to think about. So there's got to be, whether you call it brokerage, your retail brokerage, wealth management, investment division, trust department, you get to language. Let's agree on language, and then let's look for common ways to align.
Yes.
Perhaps. And some of those commonalities can be, obviously, who gives you your W-2? Who do you report to? It can be training. How do you treat all customers who walk into your side of the bank or the credit union? How do we intake customers? How do we assess customers? How do we present solutions to customers? How do we review with customers? Can be uniform, right?
Yeah. I talked about the client experience for my hypothetical $750,000 IRA. How about this? Are they getting the same general investment solution presented to them? Right? We may both platforms may use a IPS or risk tolerance questionnaire. Okay. They ought to use a similar one. But as a result of that, are we coming up with the same investment strategy? Regulatorily and otherwise, not a huge amount of risk, but it just doesn't play well when the same client can get completely different experience and completely different solutions depending on who they talk to in the building. That's a challenge.
Very interesting. The RIA side, the trust side, they're both fiduciaries. You both have to be doing what you believe is best. The bank, the financial institution has to have their investment philosophy, service philosophy, sales philosophy that needs to be consistent. It can't be employee A gives different advice than employee Z. That's what you're saying.
Yes.
I think that's all great. We agree with that completely. I'm a CFP. The CTFA, I looked at the study materials, basically the same thing as the CFP. There's a high degree of overlap. If you understand the definitions on one side, you're going to pass the test on the other. I think there's a high probability with some effort. If you can get through the CFP, you can get through the CTFA, in my opinion, and vice versa. Then further, meaning, of course, the CFP is the gold standard on the RIA side and the BD side, and the CTFA is arguably the gold standard on the trust side, right? Gold standard to gold standard are very stinking similar. But then we look at the platform, right? We need to custody assets. We could have a consistent platform. Mm-hmm. We need to aggregate and give performance reporting. We could have the same software.
Yep.
We need to have admin on both sides. We could have shared admin. They need different, just like every admin department needs different specialty training, but the majority of their core, if you did a Venn diagram, majority of their tasks overlap.
Yep.
Same thing as what we're saying with all of these. So that's the alignment. Those are mechanical items that you're referring to in alignment, not two different clearing platforms, two different business process management software, two different departments, two different desks, two different humans, two different phones,
yep.
Different training. How often do you see that alignment, Loyd?
Rare.
Less than 5%?
It's hard to put a number to it, but somewhere probably between 5 and 10%.
Okay.
And as much as I get around, I don't see all the organizations in the country, but the ones I see, probably 5 to 10% have some sort of alignment like that.
Interesting. Last question for now. What are some ways financial institutions can evolve their trust department to be more successful? A takeaway or two that you would give our audience?
2, one I've already talked about. You got to hire the right people. Right? And if you don't have them, you got to go find them. If you got them, you got to keep them. But it's all about the people on the front line. A board and the management team of the bank can say whatever they want out of the trust department. But if you don't have the right people to create that growth, everybody's going to be disappointed. The second thing is, and it's a cliche, it's an overused answer, but the organization needs to support the growth of the trust department. And let me define that support. It's not what they say in staff meetings. It's not how many lines they get in the annual report. It's, do they really support it? Is the president, CEO, CFO, head of the commercial lending department, head of retail, the best referrers to the trust department? Do business with the trust department themselves? Now let's talk about the board. That board that wants 15% profit. I'm playing off of that example, Mike. How many of the board members have their wealth with the trust department? Right? And okay, maybe not all of it, but at least some to show their support. That's true support. When the leaders of the organization are the best referrers to the trust department. And I've had board meetings where they say they want to grow the trust department and they think it's so important to do. And I go around the room and have that conversation, and it's often disappointing.
We see it in wealth management as well.
I'm sure you do.
We talk with the financial advisors that you need to have, we call it own the boardroom. You have to have friends and you have to have influence at the top, as well as, throughout the organization. The tellers need to like you, and you need to be referable throughout the whole institution. And we want our advisors to be in the boardroom every month. If you can't spend time with your employees or your department heads, you're not going to build a relationship. And if building a relationship isn't, if it isn't important to win, that's an easy way to identify it. If you can't invest 10 minutes a month, you're not going to invest any money, and you're not going to put the resources behind it that you said. So look yourself in the mirror, leadership, basically. So we want the advisor or the head of the trust department to be in the boardroom monthly, and we want them to be having quarterly meetings with the board and the C-suite. And that can be a cup of coffee. It can be lunch, but you've got to spend that time. You've got to invest that time to have that relationship to increase that referability.
Yep.
We were in a bank in the last month. They've got a fairly large board and holding company board. We're meeting with both and their C-suite. And when asked how many of them did business with their own department, only one hand went up. That's a tough decision, right? They have to make changes.
Yes.
They have to make changes, and they need a consultants that can help walk them through it, or honest vendors that can help walk them through how to make those changes, because it is too easy to ignore.
The other factor ties back to prior points and probably is relevant to your experience on the wealth management side in your world. A lot of that conversation, or a lot of the success of that conversation, depends on the credibility of the advisor or the trust officer, right? And we've had this conversation a myriad of times to a bank executive. If you aren't comfortable letting that person manage your mom's money or your money, why are they still there? Now, that's a tough conversation. But if you don't have enough confidence in the people that are in your shop, whether it be brokerage, retail brokerage, or your trust department, that's going to lead you a certain way in the decision about what to do with your department.
Yeah, that's a very powerful point, Loyd. So we are up against our clock. This has been a great discussion, and we could continue going. I always enjoy these discussions, and I appreciate your wisdom and expertise. For our listeners, how can they learn more about you and your company?
Simple answer is go to the website, of course, www.pohlconsulting.com. And there's request for information, or email me. I'm pretty easy to find on various LinkedIn, etc. So reach out to me, and I'll be glad to chat with anybody that connects with me.
Okay. Sounds good. Thank you very much, Loyd, for being part of our Banking on Growth podcast.
I enjoyed it.
And thank you to our listeners. We hope you enjoyed it as well.
This has been another insightful journey with Banking on Growth with Michael Graham and Midwestern Securities, a member of FINRA and SIPC. We appreciate your time. If you found value in today's discussion, consider subscribing for more thought-provoking discussions in the world of finance. Your support helps us continue to bring you quality insights. If you have a topic you'd like us to consider covering or have thoughts on one of our episodes, we'd love to hear it. Just email us at media@midwesternsecurities.com. Remember, the power to grow is within you. Thank you for being a part of the Midwestern Securities community. Until next time, stay inspired and keep banking on growth.